if you got a gold and silver stock is at 52-week lows when silver's over 30 and gold is over 2,600, maybe that's not a stock you want to buy more of this tax loss season. So this time is a bit different, and that's a good thing. I'm glad to have gains to be protecting rather than losses to be harvesting. So the year-end point would simply be if there's more scare, if I don't know, some apparent good news out of the U.S. knocks gold down to 2,500 or even below, I think that would be a panic moment for a lot of gold's Johnny-come-lately friends, and that could create buying opportunity.
Recent market analysis from precious metals expert Lobo Tiggre, founder of Independent Speculator, offers a nuanced perspective on current gold and silver dynamics. His caution against purchasing stocks at 52-week lows, even with gold exceeding $2,600 and silver above $30, reflects a sophisticated understanding of market timing, particularly during the tax loss season. The market has validated these insights, with spot gold reaching $2,658.11 following U.S. macroeconomic data that weakened the dollar. Meanwhile, silver maintains robust performance despite a slight 0.37% dip to $30 per ounce, having gained 26.07% since the beginning of the year. Market projections support this strength, with silver expected to test all-time highs in 2025, potentially reaching $50 and climbing to $82 by 2030. Gold's outlook appears similarly optimistic, with forecasts suggesting prices will touch $2,700 in 2025, before a modest retreat to $2,680 in 2026. Technical analysis indicates significant support at $2,700 and resistance near $2,800. Tiggre's observation that a drop below $2,500 could unsettle newer investors speaks to gold's unique market psychology. The precious metal's enduring role as a safe haven asset continues to attract both institutional and retail investors. Central banks maintain substantial gold reserves to hedge against financial instability, underscoring its importance in risk management. This institutional backing, combined with gold's historical resilience during economic uncertainty, supports Tiggre's view that temporary price dips often present strategic buying opportunities for experienced investors. He also highlights a common issue in the gold sector. Investors tend to be disappointed when the gold price is stable at an intense level instead of rising. He dismisses complaints about the gold-dollar exchange rate, emphasizing that gold mining businesses are in a solid position at current price levels. Before diving deep into this video, subscribe to our channel and hit the bell icon so you never miss an update. Also, share this video with your friends and anyone who may benefit from it.
So normally this would be a time to think about tax loss selling, but actually with silver, still holding over 30 and gold holding at or near nominal all-time highs, I don't have a lot of tax losses to worry about. And for the better companies, the other side of tax loss season is to look for buying opportunities, right? If I'm bullish, but the market is down, the stock is down, maybe, mid-December, I can get a really great buying opportunity. It's a time to go playing in the market with stink bids. But this year, not so much. If you got a gold and silver stock that is at 52-week lows, when silver's over 30 and gold is over 2,600, maybe that's not a stock you want to buy more of this tax loss season. So this time is a bit different. And that's a good thing. I'm glad to have gains to be protecting rather than losses to be harvesting. So the year-end point would simply be if there's more scare, if I don't know, some apparent good news out of the U.S. knocks gold down to 2,500 or even below, I think that would be a panic moment for a lot of gold's Johnny-come-lately friends. And that could create buying opportunities. If we saw something like that, I would absolutely be, have a garage sale, sell some blood, whatever necessary to back up the truck and buy some great stocks there. If plus $2,600 gold is all we have to worry about, we got nothing to worry about. The better companies should be making gobs of money. I think that's a technical description that this, the projects, the better projects. I mean, an aggressive gold price assumption in a project these days is 2,000 or 2,050. I don't think I've seen a 2,100 yet. And we're so far above that, again, the better projects should be able to advance. The better miners should be making money. And by the way, if you have a gold company that isn't making money, you really need to ask yourself if that's a gold company you want to own. Funny thing about gold puts, we're only happy when the gold dollar exchange rate is going up. When it's holding at a objectively terrific level, that's not enough. We want it to be going up. So let us dispense with the wailing and gnashing of teeth and pulling of hair. There's nothing wrong with the gold dollar exchange. Well, manipulated or whatever. When I say there's nothing wrong, I mean for the actual business of mining gold, we're at a fine place. And to be going into that, what most, whether red or blue, but most economists think is a highly inflationary agenda going forward, starting from the level we're at now, I think is very bullish for gold.
In a recent analysis, investment expert Lobo Tiggre parallels current market conditions and the aftermath of the 2008 global financial crisis. He points to 2010 as a particularly instructive period when economic indicators showed mixed signals of recovery and potential troubles ahead, similar to today's complex market environment. The Great Recession, which officially lasted from December 2007 to June 2009 in the United States, originated from the collapse of the U.S. housing market and the subsequent devaluation of mortgage-backed securities and related derivatives. This downturn quickly evolved into a global crisis, marking the most severe economic contraction since the Great Depression of the 1930s. Experts like David Rosenberg anticipated deflationary pressures from potential recessions during this period. Their concerns proved warranted as the housing market's transition from boom to bust triggered a domino effect throughout the global financial system. Tigre's analysis extends to policy responses, highlighting the crucial roles of both fiscal and monetary interventions. He particularly notes the Federal Reserve's actions and stimulus measures as essential tools that helped prevent prolonged deflation and recession. These historical insights provide valuable context for understanding current economic challenges and policy responses. Let's get back to the interview.
Right, what was happening in 2010? We're still dealing with the GFC, right, after 2008. For anybody who's not politically biased, and granted, there are some signs of growth. Hey, money supply is going up like crazy. But, there are ample signs of trouble. If that gets bad to where, we have that, beep moment where the brown stuff is hitting the fan, you could say, that would be deflationary. Your David Rosenbergs of the world would say, for all these reasons, all these problems, we're going to have a recession and it's going to be deflationary. There's the Fed put, and then there's the stimmy checks. It's not just the Fed. You've got fiscal and monetary policy. So I have long said that I expect the trouble to become undeniable. That may or may not work out for me this year. But I've always said, and then the money helicopters would fly. So to the point of your question, where is the scenario where we have deflation, that we have, serious headwinds for all the metals, including the monetary ones? And I don't see it, because if there's any sign of trouble, I think they unleash the second wave, the third wave, the fourth wave of the money helicopters. The instant response is, recession is no fault of people's own. We can't let them suffer, so we're going to send them stimmy checks. And not little, $80, George Bush stimmy checks, multi-$1,000 Biden era checks. Trump won't want to let Biden give away more money than he does. So I think bad news would be seen as good news by the markets, but bad news would also unleash this monetary largesse, which I think would be very, very inflationary. Obviously, very good for gold, and probably silver would tag along as well. But ultimately, despite the recessionary parts, it would be good for, copper and even nickel and iron, oil, everything. 2025 is going to be a year of inflation, and the Trump administration will be highly inflationary. That's a next year and farther ahead, so a midterm outlook. In the meanwhile, there's the pain that we were just discussing, the new statistics showing economic weakness. It'll be really critical what the next jobs number comes out, because everybody has written off what was frankly a disastrous number last month. It's just the hurricanes or the Boeing strike. Well, both of those are gone. So if that number doesn't come screaming back, then that should really be a wake-up call. And one would think that whether left brain, right brain, doesn't matter. Anybody that's serious about making money should see that and respond to that. And so if I'm right, then that would be bad news at that point. And so I'm talking very near term, as in the month ahead or two. That would be bearish for copper and everything industrial, oil too. The one exception would be uranium, because it marches to the beat of a different drummer. But everything else, it would be negative in the near term. And I see that as a buying opportunity. So I'm holding off on that. And if I'm wrong, I'll miss the bottom, but I'll still have plenty of opportunity to make money all the way throughout the Trump years and probably beyond. So I feel no FOMO. The downside for me is not that I lose money here. It's just that I miss, the best buying opportunity.
Recent economic turbulence has highlighted the challenge of balancing growth and risk. Aggressive fiscal and monetary interventions have averted deeper downturns despite concerns about deflation. In this environment, gold has proven to be a stable, safe haven asset, with its role in preserving value becoming even more critical as inflationary pressures rise due to ongoing monetary expansion. Do you think gold will maintain its strength as a safe haven asset, or are we headed for a period of volatility? Share your thoughts in the comments below. If you found this video informative, don't forget to like, share, and subscribe for more updates. Thanks for watching.